In today's episode, I'll talk about two very interesting stories. In the first story, I'll talk about what Trump's re-election really means for India and the rest of the world. And in the second story, I'll talk about how India is kind of facing a housing crisis right now. Welcome to the Daily Brief show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and information in the financial world in a way that is comprehensive yet very simple to understand. I'm your host Anurag Bansal, and today is Friday, the 8th of November. By the way, you can also follow us on Apple Podcasts, Spotify, or wherever you consume your podcasts. We also send out a no-spam newsletter every morning where we cover everything that we've covered in Daily Brief in a more written format. So if you're interested, do subscribe via Substack. All the links are there in the description below. Let's now begin with the first story. Now, of course, all of us by now probably know that recently Donald Trump was re-elected as the President of the United States. Now, it's not a surprise at all that this news has sparked a wave of discussions about how his return to the White House might impact the economy, not just in the US but around the world as well. There's a lot to look at here, from his plans for trade and tariffs to how the US will handle its national debt. So let me break this down step by step in this video while keeping things extremely simple to understand. Let's first start with the important things to know first. Look, whenever a political leader talks about changes in policy, especially big promises so to speak, we often don't see anything implemented exactly as it was planned. Many times the promises that were made during election campaigns face a lot of challenges in actual execution, especially when it comes to political and economic forces beyond one person's control. Apart from this, economic changes do not even happen overnight. So while it is definitely tempting to get caught up in dramatic headlines, it is also wise to remember that markets are driven by many factors, could be technology, demographics, global trade patterns, and so much more. And these things do not change as quickly as policies do. So with that context in place, let's look at what Trump's proposed plans are and how they could shape the economy. Now see, Trump has centered his economic agenda around a few major areas: tariffs, interest rates, dollar, and the Federal Reserves. Now these aren't new themes for him. They were very central to him in the first term as well, and now he's bringing them back with just a few updates. I'll start with tariffs first. Now one of Trump's biggest policies this time around is his proposal to add tariffs, which by the way is a kind of tax on imported goods. His America First agenda aims to bring manufacturing back to the US, so he is suggesting a 10% tariff on all imports and a 60% tariff on all goods, specifically from China. So this means that if a US company wants to import products from abroad, they would need to pay these extra fees. And this makes buying American-made goods a little more attractive. But the thing is, tariffs can be a bit of a double-edged sword. On one hand, they are meant to protect American jobs by making US-made goods cheaper as compared to foreign products. But tariffs often also increase the cost for businesses and consumers because the prices go up. To give you an example, when businesses pay more to import materials, they might also pass on those extra costs onto the consumers at the end of the day. In fact, some companies have already claimed to do that. Now, interestingly, Trump is not alone in this. Even Joe Biden, who is Trump's predecessor, had increased tariffs on China during his term, especially on items like EVs or electric vehicles and solar panels. Now, the important part here for us is that this support signals a broader trend. The US is focused on protecting its industries from foreign competition, and this approach might be here to stay for a bit of time. Then let's move on to how Trump's plans could impact US debt as well as inflation. For those of you who are new to the markets, let me give you some context before that. Look, debt is basically the money that the US government owes to others, and that has been growing rapidly. Trump's proposed tax cuts and spending plans, especially on defense and infrastructure, will likely add even more to that debt. Now, according to estimates, Trump's policies could increase the national debt by $7.75 trillion by 2035. Now, higher debt can lead to more expensive borrowing because lenders want higher interest rates if they are lending to a country that is deeply in debt. Plus, these policies could also drive up inflation. With higher spending and new tariffs pushing prices up, experts are estimating that inflation could increase by up to 7.4% over the next few years if Trump's full plans are put into place. Now, one other common concern here is about the Federal Reserve's independence. The Fed, which by the way controls US interest rates, usually operates independently, which makes decisions without political pressure. But the thing is, if Trump manages to influence the Fed, there could be politically driven interest rate changes, which could potentially allow inflation to rise in order to support government spending. Now, this could make some investors wary, which could further then push interest rates even higher and make borrowing more expensive. Now, let me remind you here that these changes are not just an American issue. They will also likely ripple across the global economy, and this is especially true because the US dollar is the world's reserve currency. Higher US debt and rising inflation could drive up the dollar's value and increase US bond yields. This could lead investors worldwide to move their money into the US, and this might create outflows from emerging markets like India and also put pressure on their economies. To give you an instance, countries like Turkey, Brazil, and South Africa, which by the way rely on stable dollar financing, could see increased borrowing costs and currency pressures. If investors pull out their money of these markets and reinvest in the US, these countries might face higher inflation, currency volatility, and an overall economic strain. With that, let's move on and talk about Trump's policies on the global market. See, Trump's approach to trade prioritizes reducing imports, especially from China, in a bid to boost US manufacturing. Now, while this sounds good for local jobs, it can also lead to other countries retaliating with tariffs of their own. And this could make things tougher for American exporters. To give you an example, if the EU or China responds with tariffs on US goods, American companies that rely on global markets like agriculture and technology firms could take a big hit. China, by the way, is expected to be one of the most affected here because US is one of their biggest trade partners. If these tariffs end up staying, China might start looking for other trade partners or even shift its focus to boosting its own domestic economy. Now, the EU or the European Union has also discussed the idea of retaliatory tariffs on American goods, especially in industries like automotive and steel. This could impact European economies that rely heavily on exports to the US, like Germany, which could face slower growth if trade tensions start to escalate. Now, emerging markets, particularly India, Brazil, and Southeast Asian nations, could experience both challenges and opportunities due to Trump's new policies. To give you an example, India has a growing trade relationship with the United States, so higher tariffs or a stronger dollar could raise costs for Indian exporters in sectors like IT, pharmaceuticals, and textiles. Other emerging economies might benefit though. Mexico, to give you an instance, could see new manufacturing demand if US companies start to shift away from China. Similarly, Southeast Asian countries like Vietnam and Thailand could also attract businesses that are looking to avoid US-China tariffs. But the thing is, it's not all good news. If global trade slows down, even these economies might see less demand for their exports. Now, moving on, Trump's America First approach is also likely to create ripple effects on a geopolitical level. His trade and defense policies could reshape relationships between the US and major global players. To give you an example, the US-China relationship is already tensed, and Trump's plans to limit Chinese access to the US technologies could make things even worse from here. Countries in Asia like Japan and South Korea may have to reconsider their strategies if US-China tensions start to escalate because they heavily rely on both of these superpowers for trade. In Europe, Trump's approach may drive the EU to become a little more independent, especially in areas like defense. This could lead to new alliances as the EU looks beyond the US to strengthen economic ties with other regions. Now, for African nations that are involved in China's Belt and Road Initiative, Trump's policies might mean choosing between competing US and Chinese investments. Now, the thing with all of this is there is still a lot that we do not know. Political plans are one thing for sure, but real-world implementation usually unfolds a little differently. The Congress, international relationships, and unexpected global events could shape the outcomes in ways no one can fully predict today. So while Trump's agendas are pretty ambitious, the actual impact will only depend on how these policies eventually play out, both in the US as well as worldwide. But by keeping an eye on big trends and understanding the basics, we can definitely make a little more sense of these developments and what they might mean for our future. Let's now move on to the second story of the day and talk about how India is kind of facing a housing crisis right now. Look, whenever we talk about the basic things in life, three things come to mind for most Indians: roti, kapda, and makan, which are food, clothing, and shelter. While getting access to basic food and clothes is not as much of a struggle today for people as it once used to be, owning a home still remains a distant dream for millions of Indians. Now, this is especially true for those in the lower income groups who usually face huge challenges in affording or even qualifying for a home loan. In a country with a population of over 1 billion human beings, the dream of owning a home is widespread but not quite equally accessible. India currently faces a huge housing shortage, which has a gap of nearly 100 million homes. Now, most of this demand, about 95% of it, comes from those in economically weaker sections and lower income groups according to RBI study. Now, in simple terms, people from these groups often do not have enough income to easily afford homes, especially in urban areas where property prices are already pretty high. Now, this gap represents a very significant opportunity, a massive 58 lakh crore credit opportunity, where housing finance can play a very, very vital role in helping these people afford a house. Now, the Indian government has been very actively promoting the idea of housing for all, and they're pushing for more people to be able to afford homes. Yet, the home loans in India currently make up just 12.3% of the country's entire GDP. To put this into some perspective for you, this is far behind countries like China and even Malaysia, where home loans make up of about 20% of their economies. Affordable housing finance companies now have stepped in to bridge this gap. They're focusing on making home loans a little more accessible to those who traditionally could not even qualify due to lower incomes or the lack of formal income documentation. Now, as of late, AHFCs have been witnessing strong growth. All major players in the affordable housing sector have been growing their loan portfolios at double-digit rates. What this means is that they are lending more money every year to help people afford homes increasingly. This growth in lending is happening mainly in rural and underserved areas of the country where people need these loans the most. Now, you might be thinking that this growth is pretty obvious because the affordable housing market has so much potential. But here is where things get interesting. Look, while the affordable housing sector is definitely booming, the overall credit growth in the Indian banking system is actually going down. For a while from late 2022 onwards, Indian banks and lenders were giving out loans faster than they were collecting deposits. This eventually led to a situation where banks had more loans on their books than they had deposits. And this started to raise concerns about liquidity, which is essentially that banks could have trouble if too many people wanted to withdraw their money at once. Now, the Reserve Bank of India or the RBI took notice of this and they asked banks to slow down their lending in order to avoid potential risks. As a result of this, after about 30 months of consistent growth in credit, it has slowed down and it is now below the rate of deposit. But despite the slowdown in the banking system overall, the affordable housing sector is still growing at a healthy pace. This resilience makes it a promising area and it stands out even as other types of lending is slowing down quite rapidly. Now, growth is pretty important in lending, as you might imagine, but what is even more crucial here is the quality of growth. This means not just lending more money, but also lending to people who are likely to repay well. In finance, if people do not end up repaying their loans, it becomes a non-performing asset or an NPA, which is also called as a bad loan. Now, surprisingly, AHFCs have managed to keep their NPAs pretty low at around 1 to 2% even while they are expanding. Now, this is even more impressive because they are largely lending to lower income groups where incomes can be very unpredictable. Now, you might be wondering how exactly are they pulling this off? Look, AHFCs use very careful strategies to assess whether someone can repay a loan or not. Instead of only looking at formal documents like salary slips, etc., they also use various other data sources and tailored methods in order to understand their customers' repayment abilities. In addition to that, their loans are also smaller and the monthly payments are also affordable, which makes it a little more easier for borrowers to stay on track. Most of the loans that AHFCs provide are for homes where people will actually live and not for investment properties. So this also gives borrowers a very strong reason to keep up with the payments because they do not want to quite lose their homes. Technology also plays a pretty big role here. AHFCs monitor repayments in real time, and this allows them to spot any issues early and act very quickly. But while AHFCs are maintaining a solid growth rate and keeping their NPAs low, other areas of lending are facing quite a few challenges. Non-banking financial companies or NBFCs that offer unsecured loans are seeing a rise in defaults. Big lending companies like Bajaj Finance and Shriram Finance have reported more people missing payments, which forces these companies to set aside some funds in order to cover potential losses, which eventually impacts their profits. Now, this stress in unsecured lending is partly because some borrowers have taken on too much debt and are struggling due to economic pressures. The RBI has advised caution to lenders and it has urged them to slow down as defaults increase in this very segment. AHFCs, however, mainly offer only secured loans for homes that people eventually live in, and this gives them a more stable portfolio. This also makes the affordable housing sector stand out a little bit for its resilience even as other parts of the lending market face a few challenges. The affordable housing sector is not just growing because of this demand, it has also some significant support from the government, by the way. Recently, the Indian government approved the construction of an additional 3 crore homes under the Pradhan Mantri Awas Yojana or PMAY, which is a scheme designed to make home ownership possible for lower income families in India. Over the past decade or so, the PMAY has already provided over 4.21 crore homes across the entire country of India, both in rural as well as urban areas. This new expansion reaffirms the government's commitment to making housing a little more accessible to all. And beyond building homes as well, the government has also introduced several initiatives in order to support the affordable housing sector. I'll quickly tell you about them. First is interest subsidies. See, through the Credit Linked Subsidy Scheme or CLSS, lower income families can now get a reduction in their EMI, which makes home loans a little more affordable. The second one is funding for AHFCs. See, the National Housing Bank or the NHB supports AHFCs by boosting their liquidity. This allows AHFCs to get funds at lower rates and in turn offer cheaper loans to consumers. The third one is faster approvals. Look, streamlined land approvals and faster clearances for housing projects help reduce costs and enable quicker project completion. The next one is developer incentives. The government offers tax breaks and incentives to developers focusing on affordable housing, which ensures a steady supply of affordable homes. The next one is rural housing focus. See, expanded programs for rural areas make sure affordable housing reaches even more remote regions. With these initiatives, the affordable housing sector is set for a pretty strong and long-term growth path. While short-term challenges like interest rates and inflation are always present, the government's ongoing support provides a solid foundation for the future of this industry. So if I were to summarize everything for you, the affordable housing finance sector in India is currently experiencing a pretty unique period of growth and stability. As millions of Indians strive to own their own homes, AHFCs are helping turn that very dream into a reality by providing loans which are accessible as well as affordable. Despite lending to economically weaker sections of the society, these companies are able to keep their portfolios clean and their risks low by using data, technology, and very careful screening methods. So with strong backing from the government and a steady demand for affordable housing, this sector appears well positioned for sustained growth. Let's now move on to the final section of the day, which is the news tidbits. First, Berger Paints recorded a modest volume growth of about 3.6% in Q2 of FY 2025. This was hampered by very heavy rains and competition from Grasim's Birla Opus, with EBITDA margins slipping by 147 basis points to 15.6%. Now, despite these hurdles, Berger Paints remains optimistic about future growth through price hikes and broader retail reach. Second, Adani Group has renegotiated its power supply deal with Bangladesh amidst delayed payments of about 7,500 crore rupees. Bangladesh has agreed to clear 20% of their dues immediately, with the rest in phases. This secures Adani's cash flow and underscores the complexities of cross-border energy agreements. Third, Apollo Hospitals Q2 of FY 2025 profits surged by 63% year-on-year to 379 crore. This was driven by a strong growth in healthcare services and reduced losses from HealthCo, which is its digital platform. Consolidated revenue rose by about 15% to 5,500 crore rupees, and this reinforced Apollo's potential in India's healthcare market. Fourth, IFC's 3,000 crore rupee plus loan to Bajaj Finance supports EV financing, energy efficiency, and women-owned businesses. This partnership is aimed to align with India's net zero goals and set a precedent for sustainable financing amongst NBFCs. That's all the news and stories that I have for you today. I hope you found value in today's episode. Please let us know your feedback, thoughts, and opinions in the comments down below, and we would love to respond and chat with you. With that, I'll take your leave and I'll see you on Monday. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.